Hello and welcome to Bloomberg Quint. You are watching this special coverage Q2 with BQ, and joining us is Mr. Unnikrishnan of Thermax. Of course, we had the company which was facing some margin pressures for the quarter, but we'll have the management now to talk about what's second quarter all about and what is the outlook moving ahead. Thank you so much, Mr. Unnikrishnan, for speaking to Bloomberg Quint and taking out the time. We have seen strong growth, on the energy and environment business. Do you think this momentum would continue moving ahead for Thermax?
For a capital goods company like Thermax, the moving ahead for the next 2 to 3 quarters is already sealed on the basis of the order book available at the time when we are speaking. So we have 6,400 crore worth of orders on hand, and a good part of them are executable in the next few quarters itself. And looking at the way we are able to manage the cash flow and also the working capital, our ability to be executing should continue to be prevailing going forward also. But what would happen thereafterwards is going to be dependent a lot more on the order intake. So in the order intake area, current quarter, though it may be a 4% lower than the last year, it is quite a decent number at 1,343 crores of rupees at the group level. If we are able to maintain the order intake for the next few quarters at similar kind of numbers, well, the outlook is fairly good going forward too.
Okay. And sir, what about the chemical business? Is the traction good there as well?
Yeah. In fact, we've seen in the chemical business, there are two verticals for the company. One is ion exchange resin, and second is the performance chemicals. In the performance chemicals, I never had a capacity constraint, it's only a market constraint and the price constraint, margin constraint. So that grows based on the availability of the market. When the market expands, I increase, or else I go to displace a competitor from an existing customer of his and then enter there. Whereas in the resin, capacity was a constraint, which you are aware that we have commissioned our new plant at Dahej, and it has almost reached a 60% capacity utilization. So I got surplus capacity available for another 40%. So the order obtaining process there for specialty resins is going on, and that should certainly offer me that opening for increasing the chemical turnover for resins. And I'm expecting a double-digit growth in that business too at the end of the year as we're moving. Already it has grown beyond double-digit in the first half. It will continue to be growing at the same rate going forward too.
Okay, good to know that, sir. And talking about the performance of the international subsidiaries, how do you see it shaping ahead, and how are the orders looking there?
I would say there was a challenge in execution and margins at the European subsidiary of Dan Stoker. It has got a healthy carry forward orders, and the difficult orders are almost behind us. So H2 of the current year should ensure that they wipe off the losses of the first half and turn out to be profitable at the end of the year. The Chinese subsidiary, as I mentioned in the earlier calls, that we have decided to stop selling in China and were to be utilizing that purely as a manufacturing center for the rest of the world where Chinese product is acceptable. But with the ongoing trade war between America and China, there is an imposition of a 25% duty for an air conditioning chiller coming from China into America. So that market is also blocked for my Chinese factory. So there are certain calls that we need to be taking. We are currently containing the cost to ensure that it comes down to a very minimal maintenance cost for that factory, and we will take a call as to how we are going to go ahead in the future. Our Indonesian subsidiary, I'm very happy to say, that started getting good traction in the market segment, inquiry generation, order booking, and even the products that have started rolling out from the factory in Indonesia, the market acceptability is as good as what we are making in India. So that's a very positive move. So that being a feeder manufacturing facility for heating boilers for the ASEAN countries, where the growth of the economy is continuing very much like India, I am expecting that we should see a positive traction in Indonesian subsidiary, though I will have to continue funding that through the losses, because the initial stages till such time they reach a break-even level, which is expected to be in the 4th to 5th year. So that's about the Indonesian subsidiary. Then coming to our marketing and servicing subsidiaries in North America, Thermax Europe Limited, all of them are doing quite positive, and all of them have got positive balance sheet also at this point of time. More importantly, the international orders for medium-sized projects, how is it faring? This quarter also we were lucky to get fairly good number of orders from the international market, even from South American market in the current quarter. Going forward, inquiry pipeline is looking healthy, but finalizations in many of the markets are not catching up the way that I was expecting in the way it happened the last year. So if that were to be improving going forward, you should see a traction, even in improvement of international order booking for the company going forward.
Okay. One final question, sir. On the margin trend, you said that there were various execution challenges for the quarter for some of your units and some of your projects. But in general, have we seen some significant rise in the raw material cost, and how do you see the overall margins in coming quarters, given the fact that internationally the commodity and the currency scenario is quite volatile?
Yeah. First and foremost, in the current quarter itself, there had been a 1.4% increase in the input material cost. It has gone up by 1.4%, which has certainly had a impact on the overall final margins for the company at the global level also. But many of those orders were taken in the last year, which got executed in the current quarter, when, if you remember, the commodity price rise was substantial. I mean, almost 40% was the last year's increase in commodity prices. Now we are not seeing a similar kind of a price rise, though there are increases, but manageable level, which we are normally used to. So any further orders that are being taken in the market, I'm not expecting, while I'm going to be executing thereafterwards, one may have to account for cost rises beyond the contingency that we normally are able to manage in the costing itself. Whereas last year it was really out of whack. And we had an advantage, going forward in the international market at least, of having rupee depreciation, which is 13%, but I believe it has come back to maybe a 10 to 11%. So that kind of a leeway is available for Indian manufacturers, engineering goods across the globe, where dollar denomination is going to be prevailing. Though the input cost may go up, you may have in the international market some amount of comfort. So if we are able to accrete or improve our international order booking going forward, margins can slightly improve going forward also. The impact won't happen in the immediate future, but at least when those orders get executed, one can see a margin improvement.
Okay, thank you, Mr. Unnikrishnan, for speaking to Bloomberg Quint. So that was the management of Thermax, hopeful of some bit of margin improvement in the coming quarters. But Agam also has the management with him, Infibeam.
That's right, Yatin. We do have the management of Infibeam.